Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at HIVE digital technologies.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And really quickly before we jump in, here is a super useful chart tool for those of you out there trading and investing. If you want some help reading your trading charts a bit more clearly, you can check out VIP Algos through the link below in the description.
Yeah, VIP Algos is basically this TradingView indicator suite. It gives you these visual buy and sell alerts right on the chart.
Exactly. And it has all these trend direction tools, support and resistance zones, and even areas to help you plan out your take profits and stop losses.
And you can use it across a ton of markets like, stocks, Forex, crypto, gold, indices, futures, stuff like that.
But just to be completely clear, VIP Algos is strictly an educational chart analysis tool. I mean, it is absolutely not financial advice.
Right. It does not place trades for you.
No, it doesn't. And it definitely does not guarantee profits. Trading always involves risk, so, do your own research and manage that risk.
And just a heads up, that is an affiliate link down there, meaning we might earn a commission if you use it, but it's at no extra cost to you.
All right, so let's get into it. Imagine trying to take a super volatile boom or bust gold mine, right, and trying to turn it into a highly predictable, massive utility company basically overnight.
I mean, that sounds almost impossible.
It is an insane undertaking, but that is the sheer scale of the existential gamble we are watching right now with HIVE digital technologies.
Yeah, they're attempting this high-stakes structural pivot, like moving away from just being a purely cyclical Bitcoin miner.
Exactly, where your revenue just totally relies on whatever crypto prices are doing that day.
Right, and they're trying to transform into this foundational artificial intelligence infrastructure juggernaut.
And, well, the market is having a really tough time pricing in that identity crisis. You've got these two totally different narratives just colliding in real time.
Are they a crypto company or are they a tech company?
Exactly, because, they recently reported earnings and the stock took a pretty noticeable dip.
Yeah, it definitely spooked a lot of retail investors who, I guess, just read the headline numbers and panicked.
Which sets up the central mystery we are trying to solve for you today. When you look at that post-earnings drop, is it a flashing red warning sign that this pivot is just failing?
Or is the broader market completely misunderstanding the mechanics here, and it's actually a ridiculously high probability buying opportunity?
Right. So, all right, let's move into the wealth building context. To figure this out, we really have to look at how a stock like this actually fits into a long-term portfolio.
Yeah, because the core thesis here is all about the difference between cyclical revenue and recurring revenue.
Exactly. For years, HIVE has been, a classic crypto play. Bitcoin goes on a run, they just print cash.
But then Bitcoin enters a crypto winter, and their margins get absolutely crushed.
Totally crushed. But this transformation into high-performance computing, or HPC, it fundamentally rewrites their entire risk profile.
How so?
Well, high-performance computing provides stable, predictable, annualized recurring revenue. It basically takes them from a speculative digital asset miner into, well, a pick-and-shovel provider for the AI revolution.
Okay, I hear the long-term vision, but I got to play devil's advocate here for a second.
Sure, go ahead.
Taking a massive crypto mining operation, which is honestly just plugging specialized calculators into a wall and turning that into an enterprise-grade AI data center, that is a huge leap.
It's a totally different technical standard.
All right, like are they just slapping the acronym AI onto their investor decks to chase the Wall Street buzzword? Because executing that kind of pivot is notoriously difficult.
That skepticism is entirely justified. I mean, it really is. But their existing physical footprint actually gives them a massive head start.
Really? Like the actual buildings?
Yeah. Think of it kind of like flipping commercial real estate. They aren't just buying an empty dirt lot and waiting 3 years for zoning permits and environmental reviews.
Or waiting for grid connections.
Exactly. They already own the facilities, the concrete is poured, and crucially, those massive electrical grid connections are already humming. HIVE operates Tier 1 data centers right now.
Okay, but Tier 1 isn't Tier 3 plus, right?
Right. Upgrading to Tier 3 plus for AI is expensive, but having that powered shell gives them an incredible time-to-market advantage over a startup trying to build from scratch.
Okay, let's actually unpack that jargon for a second, because Tier 3 plus sounds a lot like marketing speak. What does that actually mean in the physical world?
It really comes down to redundancy and cooling.
Okay.
Like, a crypto miner can afford to go offline for an hour if the power flickers. It's fine. But an enterprise client paying millions to train a huge language AI model, they absolutely cannot.
Right. Any downtime is millions of dollars lost.
Exactly. So Tier 3 means 99.98% uptime. It means dual-powered equipment, multiple independent distribution paths for cooling, massive backup generators.
So you can't just throw an NVIDIA server rack into some hot warehouse.
No, not at all. It requires precision engineering. HIVE is retrofitting their existing powered-up spaces to meet those extreme enterprise demands.
But, I mean, you can have all the physical footprint and concrete in the world, but if the underlying business is bleeding cash to make those upgrades, this whole AI pivot is just a pipe dream.
That's the big question.
Right. So are they actually generating enough money to survive this transition phase?
Well, now let's look at the fundamentals, because the fiscal year 2026 numbers reveal exactly how that transition is being funded. And honestly, the top-line growth is staggering.
What are we looking at?
Total revenue jumped 158% year over year to $297.8 million.
Okay, wow. That looks massive on paper. But if you dig into the revenue split, you realize that growth is hiding a pretty huge imbalance between the two business models.
Yeah, that is the critical nuance here. The crypto segment is absolutely still the dominant engine.
Right.
It generated $278.3 million of that total, which is up 164%, and that was driven by them expanding their hash rate from 6.5 exahashes per second to a staggering 25.1 exahashes.
Let's round that term really quick, too. An exahash means the network is processing 1 quintillion hash computations every single second.
It's a wild number.
It is. So reaching 25.1 exahashes means they have deployed a truly monstrous amount of physical computing power just to mine Bitcoin. So the crypto engine is roaring. But what about the AI engine?
Well, the high-performance computing segment is much smaller right now, but it's the entire basis for the bullish trajectory. It grew 94% to reach $19.5 million.
I mean, 19.5 million is a tiny fraction of a nearly $300 million pie.
It is today, sure, but you really have to look at the forward pathway here. They are currently sitting at $35 million in annualized recurring revenue, or ARR,
Okay.
and they are actively deploying incredibly advanced NVIDIA B200 GPUs in a partnership with Bell Canada.
Right, getting the infrastructure in place.
Exactly. And their stated goal, like the absolute North Star for management right now, is to reach $660 million in HPC annualized recurring revenue by the end of 2028.
Wait, 660 million, that's huge.
It is. And they plan to achieve that by building a massive 320 megawatt AI gigafactory.
Okay, let's hit the pause button and inject some reality into those beautiful 2028 projections.
Fair enough.
Because if we look at the actual quarter they just reported, Q4 2026 was an undeniable miss.
Yeah, it was.
Earnings per share came in at negative 30 cents, which missed the estimate of negative 22 cents. Total sales came in at 71.8 million against expectations of almost 79 million. They missed on both the top and bottom lines. That is exactly what triggered that retail sell-off we talked about.
It was definitely a short-term operational hiccup, but you really cannot analyze that miss without looking at how they're structurally protecting the company's financial health.
What do you mean?
Expanding this aggressively requires enormous capital, right? And in the mining sector, raising capital usually means issuing millions of new shares and just diluting retail investors to death.
Oh, absolutely. Dilution is the killer in this sector.
Right, but HIVE just executed a masterclass in capital allocation. They issued $115 million in 0% exchangeable notes.
Wait, what? 0% interest
0%.
in this macroeconomic environment. How does a company possibly convince institutional investors to lend them over $100 million for free?
Because of the exchangeable part. The investors are willing to forego regular interest payments because they're basically buying an embedded option.
Okay, explain that.
If HIVE's stock price skyrockets because this AI pivot works, those note holders can convert their debt into equity and capture massive upside.
Ah, I see.
But here is the brilliant part. HIVE paired those notes with a capped call.
Oh, let's break down the mechanics of a capped call, because that is the mechanism that actually protects your shares from getting diluted into oblivion.
Yeah, think of a capped call like an insurance policy HIVE bought on its own stock.
Okay.
If the stock price goes to the moon and those debt holders decide to convert their notes into shares, HIVE would normally have to print millions of new shares to give them.
Which hurts current stockholders.
Exactly. But the capped call provides HIVE with the shares or the cash needed to settle that conversion up to a specific price ceiling.
So it essentially puts a hard limit on how much dilution current shareholders will actually suffer.
Precisely. It is incredibly sophisticated financial engineering. Add to that the fact that their operating cash flow just jumped 3.5 times to $62.3 million.
Wow.
Yeah, and you see a business that is cleanly generating the cash to fund its own evolution.
Okay, the balance sheet gymnastics are definitely impressive. But let's talk about their actual physical competitive moat.
Right.
Because every major tech giant is desperately fighting for the exact same resources to build AI data centers right now. But HIVE possesses the one asset that companies like Amazon, Google, and Microsoft are literally begging for. Exactly, power.
Right.
But not just baseline electricity. HIVE operates on the 100% green energy.
Yeah, they are running their operations on pure hydropower from grids in Paraguay, Canada, and Sweden. This is basically their golden ticket.
We really have to explain the mechanics of why that specifically matters for AI.
Go for it.
So if you are an investor looking at the tech sector, you know that training a massive AI model consumes a horrifying amount of electricity.
Massive amounts.
At the same time, global carbon reporting requirements are tightening super aggressively. Big tech companies have made very public climate pledges, right?
Yeah, they've all promised to be carbon neutral.
Exactly. And running thousands of GPUs off a coal-fired power plant completely blows up those ESG commitments, which introduces this whole concept of Scope 3 emissions.
Right. So Scope 3 emissions are basically the indirect carbon emissions that occur in a company's value chain.
Okay.
So if a tech giant outsources its AI training to a data center running on fossil fuels, that data center's pollution actually becomes the tech giant's Scope 3 emissions penalty.
Oh, wow. So they get penalized for the power someone else uses.
Exactly. So HIV's total reliance on renewable hydroelectric grids gives them a massive structural advantage.
Because it's clean.
Right. They offer tech clients the ability to train next-generation AI models without the carbon guilt, keeping them perfectly compliant with global ESG mandates.
Man, it places them simultaneously at the absolute bottom of the global power cost curve and at the very top of the environmental compliance list.
It's an incredibly rare combination.
That brings us to the catalyst timeline, really, because we need to know who is going to buy all this clean computing power.
Right.
Over the next 3 months, what are the actual milestones that are going to move this stock?
Well, the immediate focus is going to be on the Q1 2027 guidance.
What are we looking for there?
The market really needs to see the real-world pace of those GPU deployments. Management has promised to double the current GPU fleet to 11,000 NVIDIA chips by the end of calendar year 2026.
I mean, deploying 11,000 enterprise GPUs is no small logistical feat. That takes time and serious coordination. It really does. But the true elephant in the room, like the biggest catalyst we are all waiting for, is the financing structure for the new AI Gigafactory.
Right, the 320 megawatt facility.
Yeah, they're planning a CAD $3.5 billion facility in the Greater Toronto area. The market needs absolute clarity on how that massive bill is going to be paid.
And while we wait on that company-specific news, there are massive macro tailwinds fundamentally shifting the landscape behind them, too. We are seeing a huge geopolitical push for something called sovereign compute.
Oh yeah, this is a major geopolitical shift.
What is it exactly?
Well, entire countries and regional governments are starting to realize that AI is simply too critical to outsource. They want their own localized AI infrastructure.
So they don't want to rely on the U.S. or other major hubs.
Exactly. They do not want their citizens' data or their government data being processed on servers sitting in another country's jurisdiction.
That makes total sense from a security standpoint.
Right. So this creates massive demand for decentralized, highly secure data centers located within specific national borders.
And beyond the geopolitical demand, Wall Street itself is physically changing the way it evaluates these companies.
Yeah, the Van Eck framework.
Right. Van Eck, the massive asset manager, recently released this new valuation framework. They are proposing that pure-play Bitcoin miners should no longer be valued as crypto companies.
Which is a huge shift.
It is. They're saying they should instead be valued as foundational AI infrastructure companies. But, let's be cynical for a second, okay? Is changing the label from crypto miner to AI infrastructure just financial engineering?
Mm-hmm.
Like, is it just a clever narrative trick to justify a higher stock price multiple?
I mean, It sounds like purely semantic hype at first, but it actually alters the fundamental mechanics of who is allowed to buy the stock.
Really? How?
Well, the mechanics of Bitcoin mining, like securing massive land parcels, negotiating industrial-scale power purchase agreements, and building liquid cooling systems for thousands of high-heat servers.
Yeah.
Those are the exact same mechanics required for AI data centers. VanEck is just recognizing that physical reality.
Okay, so they're acknowledging the overlap.
Exactly. And when that sector re-rating happens, it completely changes the liquidity profile.
Oh, because of institutional rules?
Bingo. Many conservative institutional funds, pensions, and endowments, they have strict mandates explicitly forbidding them from buying crypto stocks.
Right, it's seen as too risky.
But if this sector is officially reclassified as essential global AI infrastructure, those massive pools of trillions of dollars in institutional capital are suddenly legally allowed to rotate into the sector.
Wow. Which explains so much of the bizarre price action we're seeing on the charts.
Yeah.
Now let's pivot to the chart for a second.
Yeah, the technicals are really interesting here.
Because when we look at the actual technical structure of the stock following that Q4 earnings miss, we saw what analysts call a psychological breakdown. The stock suffered a classic post-earnings drift downward.
It is a textbook example of the market digesting recent gains while these conflicting narratives battle it out.
You see this specific dynamic constantly when a company is in transition. The headline hits the wire, right? Top line revenue miss.
And retail investors often panic.
Exactly. They assume the growth story is dead, and they immediately sell to cut their losses. But beneath that surface-level retail panic, the structural support from institutional buyers quietly remains rock solid. It creates a massive divergence.
Right. The retail market is selling the short-term fear of the earnings miss, while the institutional market is quietly accumulating shares, buying into the long-term AI transition.
And honestly, parsing out that exact kind of psychological breakdown, separating retail panic from institutional support floors, is exactly why utilizing visual trend tools is so critical for workflow.
Yeah, definitely.
It's why tools like VIP Algos, which we mentioned earlier, can be so helpful. Being able to visually map out those historical support and resistance zones prevents you from reacting purely to the emotion of a red day.
It really helps ground the analysis.
It does. But looking at the architecture of HIV's chart specifically, the technicals are strongly suggesting a coiled spring scenario. The indicators point toward a mean reversion to the upside.
Because of the institutional backing.
Right. Once that institutional rotation back into AI names kicks into high gear, the chart shows a tremendous amount of empty space above for the stock to run into.
So what does market sentiment look like right now, officially?
Well, you tell me.
If you look at how Wall Street analysts are actually behaving, that institutional support is undeniable. The contrast in sentiment is incredibly stark.
Yeah, we just talked about the bearish retail reaction.
Right. But the Wall Street sell-side analysts are overwhelmingly bullish. And crucially, they maintain that bullishness even after the earnings miss.
Which is wild because usually a top and bottom line miss brings a wave of downgrades and lowered price targets.
But the exact opposite happened here. Following the Q4 report, B. Riley Securities not only maintained their buy rating, but they actually raised their price target from $5 up to $8.
Wow, an increase.
Yeah. Rosenblatt maintained their buy rating and raised their target from $5 to $5.50. And H.C. Wainwright reiterated their buy rating with a solid $7 price target.
So Wall Street is completely ignoring the quarterly variance. They just do not care about a $7 million revenue miss today when they are looking down the barrel of a $660 million recurring revenue pipeline by 2028.
Exactly. They're looking at the long game.
But let me push back again because talk is incredibly cheap. Price targets are literally just theoretical numbers typed into a spreadsheet.
Fair point.
What is management actually doing in the physical world with their capital? Do they genuinely have conviction in this pivot?
Well, you just have to look at the real estate they are acquiring. They recently executed a $58 million land purchase for a 25-acre site located right in the Toronto-Waterloo corridor.
Okay, so they're buying land.
But this isn't just cheap land in the middle of nowhere. The Toronto-Waterloo corridor is a premium tech ecosystem. It has dense fiber optic networks and access to a massive talent pool of engineers.
So it's prime real estate for a data center.
Exactly. You do not spend nearly $60 million on premium tech real estate unless you are absolutely fully committed to getting that gigafactory built. That is undeniable insider conviction manifesting in the physical world.
Okay, $60 million on land is a massive commitment. which frankly leads perfectly into the risks. Let's talk about the risks, because this makes me the most nervous about the entire thesis.
Yeah, let's be very clear-eyed about the execution risks here.
Because they are severe. We casually mentioned a CAD $3.5 billion AI gigafactory earlier. Let's really do the math on that.
It's a huge number.
This is a company currently generating just under $300 million in trailing annual revenue. Taking on a $3.5 billion capital expenditure is more than 10 times their total revenue.
Yeah, it's essentially a bet the entire company move.
Absolutely. How on earth do they finance that? Traditional debt will have crushing interest rates. If they go the joint venture route, they give up massive equity in the project. And if they fail to secure favorable terms, they will be forced to issue shares on the open market, triggering catastrophic equity dilution for the current shareholders.
The sheer scale of that CapEx requirement is undeniably the largest single risk factor on the board. There's no getting around it.
And it's compounded by their ongoing crypto dependency. Yes, the high-performance computing segment is growing, but we established it is only generating $19.5 million right now.
Right, a drop in the bucket compared to the crypto side.
The vast, overwhelming majority of their operating cash flow is still coming from mining Bitcoin. That means they're relying entirely on the profits of one of the most volatile digital assets on Earth to subsidize a multi-billion-dollar infrastructure pivot.
It's a fragile bridge to cross.
Very. If the price of Bitcoin crashes and enters a prolonged crypto winter, the funding mechanism for their AI transition just dries up overnight.
Those are severe existential threats. I mean, absolutely. But you do have to weigh those risks against the specific mechanisms management has already put in place to survive them.
Like what?
Well, yes, the CapEx is terrifyingly large, but their proven track record with that highly creative 0% note financing proves they are intensely focused on protecting shareholder equity.
That's true. They did navigate that well.
And regarding the vulnerability to a Bitcoin crash, you have to look back at their green energy moat. Because they operate on hydroelectric power, their cost to mine a single Bitcoin is incredibly low.
So their margins are safer.
Right, they sit at the absolute bottom of the global cost curve. In a severe crypto bear market, other miners who rely on expensive natural gas or coal are forced to unplug their machines.
Because the electricity literally costs more than the Bitcoin they are mining.
Exactly. But HIVE does not have to unplug. Their survival threshold is drastically lower than their competition.
That is a crucial dynamic. The cheap, renewable energy basically acts as a physical shock absorber against the volatility of the crypto market.
It buys them time.
It buys them the operational runway they desperately need to complete the retrofitting of those data centers. So with everything on the table, what's the final verdict?
When you weigh the underlying financial health and the massive structural pivot against the very real execution risks, the final verdict is a bullish score of 8.5 out of 10.
Okay, an 8.5.
Yeah, we view this as a highly compelling multi-year hold, specifically targeting that 2026 to 2028 window.
The long game.
Exactly. The primary upside driver is incredibly clear. They have a visible 10x scale-up pathway to reach $660 million in annualized recurring revenue through the AI Gigafactory.
Which represents massive asymmetrical upside for investors who can stomach the short-term volatility.
But you must keep your eyes wide open to the downside, which remains entirely tethered to how management structures the financing for that massive $3.5 billion capital expenditure.
And as always, remember that everything we have discussed today is purely for educational purposes. We are providing you with the context, the fundamental mechanics, and the analysis, but this is absolutely not financial advice.
Right, you have to do your own research.
You must do your own independent research, assess your own risk tolerance, and make your own investment decisions. And, if you want a cleaner, more visual way to read trading charts while doing that research, be sure to check out VIP Algos through the link below in the description.
Yeah, VIP Algos is a comprehensive TradingView indicator suite.
Right, it features visual buy and sell alerts, trend direction tools, mapped out support and resistance zones, and areas to help plan, take profits, and stop losses.
It can really significantly help make complex charts easier to scan and understand.
But remember, it is still only an educational chart analysis tool. It is not financial advice, it does not execute trades on your behalf, and it does not guarantee any kind of results. Trading in any market involves substantial risk, so always do your own research and strictly manage your risk.
And again, that is an affiliate link, meaning we may earn a commission if you choose to use it, but at no extra cost to you. And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.
Think about this before you go. We are watching the raw infrastructure of the old internet, the massive data centers and the crypto mines. physically mutate into the brain tissue of the new AI economy. If a company like HIVE can successfully build the bridge between the wild volatility of digital currency and the insatiable energy demands of artificial intelligence, what does the global balance of technological power look like 10 years from now? See you next time.